Hi, welcome to Aussie Made. I am Ruzna, a professional accountant. I'm here to teach you some basic accounting principle. And please like the video, share, and subscribe for more information. Come, let's begin the tutorial. So, accounting is not very hard. It's very simple if you understand the basic principles. So, first, you should know what are the main elements of accounting. So, first, you should know what is asset, liability, expense, and capital. So, we're going to learn only these four topics today. With a very strong foundation, and you can lead to a very successful accountant at the end of the day. So first, let's go into account assets. Assets are the items which are owned and controlled by the business with an expectation that it will provide future benefit. What does it means? It means now if you are an owner, you have the ownership of a building and you own the building. Therefore, you can own it and you can control it. So that's what you call as an asset of a business. So what happens here? The owner has the rights to own and control the business. So, what are some examples of assets? Furnitures, bank, cash. Then we move on to liabilities. Liabilities are the owings of a business, which is an obligation arising from a past business activity. So, how does a liability occurs? A liability occurs due to purchases of raw material. So, this is simply an example where how creditors arise. How does creditors get created? You go to a place and you want some raw materials. Maybe you are making some pencil, you want some wood, and it cost you some $50,000 to purchase the raw materials. What you do is you pay a $20,000 in advance, and then you leave the $30,000 that you will make a promise that you will pay that in the future. So this $30,000 will be your liability, and the person whom you have to pay is called the creditor. So what are some examples of liabilities? Creditors, loans, and etc. Let's move on to expenses. The expenses are the cost incurred in or required for something due to the business activity. Because you're running the business, there is always an expense created every day. To run the business, you need some electricity. If there is no electricity, the machine for making this pencil will get stopped. So what do? So you have to pay your bills for your electricity, and then if you do not have a place to own, you rent it. So you have to take on a lease or you have to take on a rent, and what happens? Then you can own and control the building where you're running the business. And also wages is a very big example of expense where you have to pay to your workers. So they have to come to work as a laborer, and you pay them every day, maybe $20 an hour. So if they do not come to work, what happens? There is no manufacturing happens. So without these expenses, it is very hard to make our final product, which is this pencil. Let's move on to the capital. The very important element of all of them is the capital, because this actually comes from the beginning where the owner invests money into the business to start it, to expand it. So a owner invests $50,000 to start the business. This is called a capital. Later, when we move on to other entries, we will be calling it as owner's equity. So later means maybe if we are moving to the balance sheet, we call it as owner's equity. So what happens here? Now you have to watch this clearly what I am doing. You make this all this into a T account. So what happens here? You split this into two parts. This is your right side and this is your left side. You call this as debit. and you call this as credit. So this is your debit side and this is your credit side. Now what happens here? So what happens here? The asset and expenses, if it increases, it will be on the debit side. The liability and the capital, if it increases, it will be on the credit side. For an example, when a business purchases a furniture, that furniture is coming into the business, like it is coming in. Whatever coming in will be on the debit side. Whatever is going out is on the credit side. So when you are, how does your liability increases? The liability increases when your creditors increase. Now you are purchasing more raw materials, you create more creditors, then what happens? Your liability will increase. When your liability increases, you have to record it on the credit side because you have to pay them. So what happens here? You have to pay them. So it is going out. Therefore, it has to be on the credit side. So simply we have started how to classify these things and the basic accounting items. So now we know that this is the basic for the double entry system. Next we can look into the double entry system in my next video. If you like this, please like my video, subscribe and share. Thank you.